There has been a huge shift in a critical corner of the monetary world. Key indications that have absolutely plunged over the last little while, last week and a half. Record lows and record negatives in all of the big numbers. And the worst part is, data and evidence continues to migrate in their direction, not just in the macroeconomy, but also deeper down in the monetary system itself too. Well, most everyone has heard the yield curve, and are at least somewhat familiar with what it is and how critical it is to understand and follow. There is actually an even more important part of the global financial system. Interest rate swaps are absolutely essential to how the money world works. And that means it both impacts the real economy as well as takes cues from it. Now, the latter comes in ways you just can't get any other way. This is basically the deepest inner workings of the entire global reserve currency system, giving you information about what those operating way down deep in the shadows are doing. Not just what they're seeing, how they're responding to it all. But like any market, the indications we get aren't perfect. We aren't staring into a crystal ball. And these signals are open to interpretation. They can tell us what, but it's oftentimes up to us to figure out why. But with swaps and their spreads basically on a rampage here, we really need to give it a shot. The thing is, as I said, the data keeps moving in the direction of these spreads, making what may have seemed a cloudy interpretation much less so as we go forward. And as that view has cleared up, swaps have gone even further in that same direction. And that includes this last little while. While today, much of the financial world is near euphoric about the election results from yesterday, it is absolutely important to stop and take stock of where things stand before we try to start piecing together whether or not anything has absolutely changed and actually changed from yesterday's results. So if we look at how we got to where we are, over the last year plus, almost a year and a half, interest rate swap spreads have continuously moved in this same direction. They keep moving lower and lower, more and more negative. And an interest rate swap spread is simply comparing the fixed rate of the interest rate swap with the same maturity nominal U.S. Treasury yield. Now, they're supposed to be positive, and there's a whole discussion about why they aren't. But what we see through time is that interest rate swap spreads move with a whole bunch of other indications telling us that participants in the monetary system, either from the dealer side, money dealers, the real money itself, and how it circulates throughout the Eurodollar system, as well as those seeking interest rate swaps for debt transformation as well as hedging, how the entire system is looking at conditions and forecasting and predicting as best as possible about where everything will go in the context of interest rates themselves. Because interest rate swaps are tied in this case to term SOFR, it's about where short-term rates are likely to end up over the longer run. When we focus on longer dated interest rate swap spreads, that's what we're really talking about. We're talking about how the marketplace isn't thinking about interest rates tomorrow with the Federal Reserve and its next rate cut. It's thinking about where everything is likely to go, again, as best as possible, over the intermediate and longer terms, which is incredibly powerful information. And how we got here is that interest rate swap spreads began to move more negative way back last summer. At the same time that in the middle of 2023, remember the Treasury market was selling off, especially August and September. Everybody was talking about higher for longer, 1970 style inflation. The Fed was going to be hiking rates forever into the future. Interest rates themselves were going to go double digits, all that the hyperbole that came up in late 2023. Well, the swap market was going in the other direction. A little bit at first, but from July and August of 2023, we see rate swaps start to go lower and swap spreads start to go lower at the longer end maturities or the longer term maturities, suggesting that the market was thinking whatever was going on in the short run at that time, September effect, over the long run, what was more likely to happen from the perspective of interest rate swaps was that rates were going to go down, not in late 2023 or early 2024, but again, more likely than not over the longer term. And that's kind of where we're starting to get to here in late 2024. And over the last year and a half, they've continued to grind lower, not always in a straight line, though the 30-year maturities we'll see in a second has been closest to a straight line. But over the last year and a half, they've ground lower and lower and lower, despite the fact that we've gone through this back and forth and commentary as well as data, whether it be consumer prices, the Fed's positions, and everything else. Swaps have been relatively constant this whole time about where interest rates are going to end up, again, in the long run. And over that time, back and forth, wide variations in macroeconomic data and monetary conditions, more and more that moves in the direction that swaps have already been moving into. So we've had consumer prices. Remember, we started out in late 2023, the bond rally, disinflation in consumer prices. Then suddenly early 2024, with auto insurance premiums going up, we got sticky inflation, gasoline prices and all that early part of this year. Then it went back to disinflation over the summer. And now they're talking about maybe undershooting consumer prices, because despite those back and forth, consumer prices themselves are moving in the way that would be consistent with lower interest rates into the future. Central bank policies, remember, they went from higher for longer to now how fast do we need to cut rates? But even the global economy, it's gone back and forth between a no landing, that was a couple times earlier this year, then there was the slowdown, then there was a soft landing, then there was the recession scare in July and August. Then we came back to a soft landing again. But now, after the latest payroll data and a couple other things, the recession scares back up. But now we've got Trump euphoria over the election. So perception and commentary about the economy continues to swing wildly in one direction or the other, but the swap market has been relatively consistent through it all. And as I said, despite all of those back and forth, it's moving. The weight of evidence continues to move in the same direction that swaps are already been into. So as of Monday, a huge move last week up until Monday. There was a little bit of a setback yesterday, but up until Monday, all three of the major long-run maturities, the 5-year, the 10-year, and the 30-year, saw record lows. Even the 5-year saw record SOFR lows. And some of them, like the 10-year, are getting close to record lows in either SOFR or LIBOR, which would be historic lows. The 5-year swap spread began to plunge, really to take a dive here, around October 22nd. And it's down more than 7 basis points since then, which is by far a record for the SOFR-based version of the 5-year maturity. But the current move really goes back to September 18th. In September 18th, we're talking about the Fed, its rate cuts, basically confirming, contrary to its previous position, not all that long before, that rates are going to go down. The Fed actually sees the same things, at least part of the same things, that the swap market does. And before that, we keep coming back to June 12th, which is all over these swap spreads and a lot of other places as well. And June 12th happened to be two FOMC meetings before the September rate cut, which is interesting because in June 12th, the Fed came off as aggressively hawkish. It raised its Fed funds projections. It had higher inflation estimates. The rhetoric which came out of it was higher for longer. We're more concerned about inflation. Yet that was the moment in which the current trend in swap spreads, the more negative trend in swap spreads, really started to accelerate. That's when we saw all of the recession scare type of behavior, whether it be in the yen carry trade or just in the regular financial markets, develop during the summertime. It started with that Fed meeting for reasons I can't really identify here. There was something about the June 12th Fed meeting, there must have been, that the swap market took as either they don't get it and they're going to soon, or there was something in the meeting or the rhetoric that confirmed, yep, central banks are going to get out of the way and interest rates are going to head down where they need to go, given the fundamentals that we see in the real economy. That's the position the swap market took. You see the same thing in the 10-year maturity as well. There was a big drop starting on June 12th of this year, so it can't necessarily be the Fed policy as the Fed describes it at the time it's undertaking its policies. Because in June 12th, again, the Fed was higher for longer. We're more aggressive about thinking about rate hikes. We're talking about inflation risk more than anything else. And then in September, obviously, they're on to unemployment. That part of the economy, they say the risks have shifted. They're cutting by 50 basis points. So swaps have been moving in the same direction, even as the Fed has flip-flopped from one position to the other. Big move more recently after October 21st and 22nd, which really puts the focus on last week. And remember, last week we had all that data that came out, a whole real big time data deluge. We had a bunch of disappointing statistics and a couple other things sprinkled in. Not only just the payroll report at the end, which I think a lot of the marketplace had a sense it was going to come up bad, as it did. It was also jolts and hiring in other parts of the labor picture that were increasingly negative. GDP was seemingly solid, but as I pointed out in a video last week, GDP always looks like this just before turning off into a recession. the 10-year swap spread hits a new record low, which is almost a record low for any kind of swap spread, whether LIBOR or SOFR based. So it's already worse than 2020, at least according to the 10-year spread, and equal to the lows from 2016. And what you see in the 10-year swap spread is a very close correlation between these reflation and Eurodollar cycles. When swap spreads are compressing, which means going lower and becoming more negative, that's a negative sign about the real economy as well as the monetary system and things that go in it, including collateral. When swap spreads are decompressing and moving less negative, that's usually a reflationary signal. So the fact that swap spreads have gotten to be so negative and moving so consistently in that direction ever since last summer makes sense in the hindsight of how all of the relevant macroeconomic factors, from consumer price rates, lower inflation rates, more disinflation, to the behavior of the global economy and now the U.S. labor market, that has gotten consistently weaker, whether people want to believe it or not, consistent with swap spreads going lower. So there is a macroeconomic case for what's happening and what we're seeing in the interest rate swap market. But in the end, despite the back and forth and volatility in the short run, the behavior of swaps at the various maturities, it all comes back to the same thing. What are interest rate swap spreads actually telling us? As I mentioned in a recent video, not all that long ago, going into the details about what are interest rate swaps and how we interpret them, what they're basically saying is when you get more negative spreads, especially at the longer dated maturities, is that the market is hedging for and preparing for and thinking about short-term interest rates that not only go down, but tend to stay there. That's what the longer dated swaps really tell us, that interest rates end up going lower, but don't just pop right back up as they might in an actual recession where you have a sharp downturn and then a legitimate recovery following it. What we're looking at is something more like the 2010s, where rates fell down pretty low and then struggled to ever get higher. In fact, they really didn't get higher. The Fed tried in 2017 and 2018, only to have to turn around even before we got to the 2020s and the pandemic. So what interest rate swaps are telling us, what they're really telling us, is that the market is thinking rates have to go down and stay there. They're going to go down quite a bit and then stay there for a prolonged period of time. That's especially the message from the longer dated maturities like the 10 and the 30 that aren't swayed by short run shifts in either Fed rhetoric, Fed interpretations, changes in the short run conditions of macroeconomic data like the CPI or something else, more focused on the long term. And that's what's really compelling here, is that the swap market hasn't shifted off of it since last summer. As I said, the world continues to move more in the direction of swaps and the way spreads are behaving than not. And now, more recently, we get a huge and really emphatic negative in swap spreads in all of the maturities, short as well as long run. Why might that be? Well, as I said just a couple minutes ago, one reason is because the macroeconomic case is building and building and building for what would lead to interest rates in the first part going lower as a start, which is recession. Now, it doesn't necessarily have to be recession, but that would be the most consistent as well as the easiest straight line path between where we are now and getting to this future that swap markets are describing. But the more the recession case or the downturn case continues to build, the more it looks like we have an open pathway for interest rates to go lower. Then we can talk about how they end up staying lower. But the more the data looks like a recession or a substantial downturn, something that isn't the soft landing, the more consistent it is with the picture from swaps. So the big move over the last week makes sense given the macroeconomic statistics that we got. And I talked about the labor market data, jolts, and everything else. Nominal incomes, which is a huge one. In the energy markets, as I talked about in yesterday's video, gas oil demand is predicted to decline across the world. That is consistent with an economy that's really experiencing difficulties. That would certainly lead to interest rates going lower. So this macroeconomic case that continues to build for rates to go down, and then we have to figure out why they would stay there. But the market, the swap market in particular, is increasingly emphatic about those probabilities. There are also monetary indications we need to consider as well. Though they are not flashing huge warning signs, I've talked about this quite a bit recently because there's something going on in terms of collateral through the Eurodollar system. A lot of it seems to be focused on the yen carry trade, especially the timing with early August, suggesting that the yen carry trade, the real yen carry trade, not what you hear about in the mainstream media, continues to unwind in reverse, which is also tied to U.S. recession risks as well. And I did a video on this just last week on October 28th. If you want to talk in further detail about the yen carry trade, how that fits in with collateral, what we're seeing as far as Japanese government bills, the rerouting of U.S. dollar borrowing through the FX markets, all of that stuff, check out that video on October 28th. But essentially, we continue to get all of the same carry trade unwinding indications and all of the downstream consequences that go with it, including collateral disruptions. The 3-month Japanese government bill continues to be near zero. In fact, it's getting a little bit closer to zero over the last week or so, even though the Bank of Japan is sounding more hawkish, talking about further rate hikes. And the current overnight benchmark rate from the Bank of Japan is 25 basis points. So already a 3-month bill is almost 25 full basis points below where the policy rate is right now. And as the same thing with 4-week Treasury bills or any Treasury bills, when they're below policy rates, that tells you there is value, or there's perceived value and utility in the instrument over and above the return characteristics from the interest rates. We've got a broken trend in repo fails that times exactly to the yen carry trade eruption in early August. So repo fails, that trend continues to go up, and we'll see tomorrow about the latest weekly data. But the last week that came out showed almost $200 billion combined in fails, which is not a huge total, but it continues the rising trend, which is consistent with more difficulties in collateral, especially when you consider just how many Treasury bills there are being offered and sold by the Treasury Department itself. With this amount of this deluge of Treasury bills, we really shouldn't be seeing collateral difficulties to this degree at all. So the fact that we are consistent with that part that affects dealer behavior in the interest rate swap market. And by the way, if you want more details and to really understand what's going on, this is something we've talked about at Eurodollar University in both our deep dive analysis as well as in the memberships. I'm in the second part. I've published the second part of a multi-part basic series on interest rate swaps and interest rate swap spreads. Got a couple more left to do in that series, but if you want to know what's going on about interest rate swaps and swap spreads, what they are and how to really interpret them, check out Eurodollar University's the deep dive analysis as well as the memberships. So even though interest rate swaps themselves are incredibly complicated instruments, in big picture terms, it's not that difficult to interpret the spreads. Again, they're open to a lot of different variables. We have to factor a whole number of things, but in big picture terms, we see swap spreads that are compressing this much and this quickly. That's not a good sign about perceptions from inside the monetary system with inside information that we could only dream of. Now, all it tells us is that the market is hedging for and preparing and expecting that interest rates themselves, short-term interest rates, are going to go down quite substantially and stay there. We have to fill in the blanks about what that would mean. What would lead to interest rates going down in the first part and then staying there for the second part? It seems a recession case seems consistent with at least the first part, and then we have to fill in what the rest of it actually means. So as the world continues to question soft landing versus recession, and more of the evidence continues to land in the direction of recession, including, as I mentioned, collateral, which is tied to the yen carry trade, which is also tied to forward perceptions of U.S. recession risks. So if you do have a bad economic climate and difficulties in money to go along with it, that would get interest rates to go down. And if the economic climate and difficulties in money get to be bad enough, that would also account for rates staying there. So that's where the market is today. And the question a lot of people are now asking is, does Trump change any of that? Well, that part we're about to find out. As I said, if you want a more detailed look into interest rate swaps, check out Eurodollar University's memberships and deep dive analysis. Now, I did a video not long ago talking about the general overview of interest rate swaps and spreads. That's the one linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.